I think it's kind of what we talked about 3 weeks ago. Like the bottom is kind of in for the short term, so it's really exciting actually to see. I think this is the point where you have to now start to get pretty constructive about where things are going. Because if this stuff could not bring the market down, it's hard to see something other than an exogenous event, probably some Russia-Ukraine event, really having a negative impact. So to me, I'm kind of like, I don't know, it seems like pretty bullish for me.
Well, also GDP was 2.6%. So, I mean, this very weird conflicting data. We had 2 negative quarters of growth. We're in a recession. Then we have the third quarter is up 2.6%.
I think the stock market is going up. Then it'll go back down.
Short term up. And
we've generally been positioned for it to go up. And at some point we will reverse and position for it to go back down, but it's going up.
I said that we were going to have a double dip. That was the most likely thing. So we had this sort of mild technical recession based on nominal GDP growth not being bad, but simply not quite keeping up with the inflation rate.
Yeah.
Now things are a little bit better, but I still think the huge recession is to come next year because of all the interest rate increases we've seen. So the Fed is, pedal to the metal on interest rate increases, just like they were pedal to the metal on printing money. And so first they were too loose, and now they're probably being too tight too fast. So I think we're headed for a huge recession next year. And I think you're seeing that in the softness of all these forecasts.
Let's just say that you're an analyst that works at a large hedge fund or a mutual fund. And you woke up on Wednesday and you had a decent day, and then you went into the earnings call believing that, there's a value play here and there's a lot of upside, which I think there is actually. This company can throw off an enormous amount of cash. But then what you hear is, okay, we're spending $4 billion a quarter. That's going to go up materially. And then we're going to keep 23 spending levels roughly the same to the future. So then you have to go back and build a model. You're going to be hard pressed to not get to this number. Maybe you don't get to 250. Maybe you get to 200. My point is, all of a sudden you have to go back into your, portfolio manager and say, they're going to spend all of this, after-tax cash flow on this stuff. Or sorry, not after-tax cash flow, but, below the, above the line spending on this stuff, which won't come back to us as shareholders. And we're going to dilute the stock 2 or 3% a year. So that's another 20% dilution. And it just becomes I've said this before, you move the stock into what's called the too hard bucket. From the it's obvious to, wow, that's really tough, and I'll just take a wait and see approach. I think yesterday there was a quarter billion shares that traded hands of Facebook, just a ginormous number. So there's tax loss harvesting for individuals. By the way, there was a couple comments. A bunch of these mutual funds year ends are actually October 31st. So to your point, Jason, the stock basically gets decimated 25% in a day. The T Rows and the Fidelities are like, all right, book the tax loss and be done, and we'll relook at it next year, quote unquote next year. So, if you put on the spread trade, so we talked about the spread trade, there was a big hedge fund manager that, November 6th, right, when we were basically calling the top of the market and told people to sell, one of the trades that he put on, Nick, if you want to just throw it up, was this long Google short Meta spread trade. He called to tell me that, he closed it out yesterday. This is how that trade did. So yeah, there was just a lot of folks that just kind of like went to the exits and said, you know what, we're kind of done for the short term. I just think that it's a moment in time where those folks have to realize that they just have to explain a little bit better how they want to spend the money and show a little bit more incremental progress that justifies that level of spend. Otherwise, people will be a little skeptical. They'll build their own histogram and it'll violate too many rules. And so it goes into the too hard bucket.
Amazon reported their Q3 earnings yesterday, Thursday. Total revenue, $127 billion, up 15% year over year, 5% quarter over quarter. Net income was $2.9 billion. And they're predicting, they're giving slower guidance going forward.
I mean, what's incredible on this chart is that, when everybody talks about being long the S&P 500, it was always really a proxy for being long Amazon, Facebook, Google, Microsoft, and Apple. And at the peak, in May of this year, it was still 25 cents of every single dollar of the S&P 500 were these 5 companies. And, we always said the market bottom will be when the generals, quote unquote, get shot, to borrow a phrase from Gavin Baker. And it looks like the generals have been shot.
Yeah.
And what's incredible is this week, every single one of those companies, other than Apple really, reported pretty crappy earnings. They got totally taken to the woodshed. the percentage of these companies as a percentage of the S&P is now, off by 500 basis points. It's down to 20%. Yet the markets are ripping higher.
Look at the mortgage rates right now. Something like 7.1%.
Mortgage rates are crazy. They broke the backs of the housing market. The inventory and prices, inventory shot up. Prices have shot up. New mortgages have gone down. And, we talked about job openings. Here's the Fred chart for job openings real quick. You can see the peak we were talking about. We were wondering if that would come plummeting down. Well, here it is, folks. Yeah, plummeting down from 11 million, losing 1 million in a month. Yeah, job openings coming smashing down. There's the Fed fund rate. That's a pretty high ramp. So you think double dip recession?
The big event in the Ukraine war debate this week was that the House Progressive Caucus put out a letter signed by 30 progressive members to merely suggest that while we continue to fund Ukraine on a virtually unlimited basis, we also, in parallel, open up a diplomatic track with Russia to mitigate against the threat of us being drawn into the war, and specifically a nuclear war. And just that very, I'd say, anodyne letter, that very tepid sentiment, really, they weren't questioning in any way the providing, again, of virtually unlimited support to Ukraine. That met with such a fierce reaction on social media and in the traditional media that I think all but one of the signatories recanted or walked back the letter. And kudos to Representative Ro Khanna for not being one of the people who recanted. He stood tall and gave an interview on CNN and MSNBC saying, why has diplomacy become a dirty word? I voted for every single appropriation to give aid and weapons to Ukraine. I'll continue to do that, but I don't see a problem with us maintaining diplomatic relations. We might need those to avoid an unwanted escalation.
Well, and here we are. Yeah.
Kudos to him for standing tall, but it's amazing to me that the Progressive Caucus, which used to be one of the groups in Congress that questioned American involvement in foreign wars, like the Iraq War, they basically, they have moved off that, and they threw in the towel so quickly on this. It was really kind of pathetic to see.
What is the point of recanting something that was so benign? It's not
totally.
No, but what do you think? What's happening behind the scenes? Like, why are people so afraid to say that you can be in support of Ukraine, but also still try to find a resolution? Why was that turned into such a scarlet letter?
It's a great point, and I think it just shows the heat right now on the issue. Here's what I think.
Does it do that, or does it just show the progressives as just kind of clown towns?
I mean, it's kind of sad. I mean, Jayapal, who was sort of the leader who put out the letter, threw her own staff under the bus. And I guess there was this snafu where the members all signed this letter in July and then held it for a few months, and then they put it out 2 weeks before the election. I can see why that timing didn't make sense. I don't know why, they released it now, not 2 months ago, not 3 weeks from now after the election. I can understand all those political considerations. But once you put the letter out, just stand by it. Don't throw your own staff under the bus, because like you're saying, the letter was really a pretty anodyne statement of, hey, listen, do you think we can just have diplomacy on a parallel track at the same time that we're arming Ukraine? I just don't see the downside. But look, here's why I think they took so much heat is there's a lot of people on this issue who start with the end result of what they want. And the end result that they want is that Putin and Russia leave Ukraine with their tail tucked between their legs, and they basically don't get 1 square inch of Ukraine. They believe that is the only acceptable moral outcome here. And they may be right about that. But then what they're doing is they're kind of reverse engineering all the beliefs that they have based on that outcome, that moral outcome they want to get to. So for example, for the longest time, you heard things like Putin is definitely bluffing about using nuclear weapons. Well, how do they know that? They don't know that. They can't say that for sure, but it's what they want to believe, because if you believe that nuclear war is a possibility, you might not go all the way for that maximalist position of the only acceptable outcome here is Russia leaving with its tail tucked between its legs. And hold on. And I think the same thing is happening here with diplomacy is people who want a certain result in the war are afraid that diplomacy might result in something less than that. But that's not a reason not to engage in diplomacy. And it's not a reason to deny the potential of this war to spin out of control, potentially into a nuclear war.